Okay, so we'll start with valuation and investment. And the first thing we want to do with valuation and investment is to speak about, we'll focus a lot on the valuation of stocks. We'll also do the valuation of bonds eventually. But the first thing we want to do though is to focus on sort of the basics behind valuation. Okay, and then so that we'll review a little bit of theory before we sort of get to the stage. What is value? Value is essentially the worth of an asset. An asset's value is how much it's worth. When we speak of value, we typically think about so-called intrinsic value. Value is somewhat different from price, which is another notion of value. But price essentially is more a case of how much it will cost you to buy the asset, which is related to how much the asset is trading in the market. So the price then is related to its market value. And then of course the book value is what's called the historical cost, how much it cost in the past when it was purchased, and how much is sitting on your books. So a lot of what we want to deal with essentially is how you get the intrinsic value and compare it then to its market value to see if it's worth buying or not. The basic principle behind this is the time value of money, okay? And that is that assets, that is when we speak of assets here, we're speaking about productive assets or financial assets. So financial assets or productive assets essentially generate cash flows. Okay? If it's a financial asset, its cash flows will be interest rates or dividends. If it's a productive asset, its cash flows will come from the revenues, okay, that you get when you sell the good or some asset is producing. If it's a farm, for instance. So the basic principle then is that the value, the intrinsic value, okay, is nothing more than the present value of these future cash flows. Now, there are essentially returns you get then from the stock or the asset, and the returns then will come from the cash flows. Plus, if there's a change in value, you also get returns. We know from accounting, these are called then income-based returns, and these are called capital gains returns. So that's stuff we know, of course, from finance and accounting, and that the intrinsic value is simply the present value always. Now this is the formula, but we know Excel can do this quite easily using the PV function or the MPV function, right, to calculate this. So we're able to do this fairly straightforward. The big thing though, however, is since Excel can do this easily, the big thing is how do you get these cash flows? Right? Okay, how do you forecast what those cash flows might be? How do you get the discount rate to use? Right? And then how long will these cash flows go on for? And so that's the whole, shall we say, trick about valuation then is estimating these guys. The cash flows, the discount rate to use, and then how long the cash flows will go on for. So we'll kind of start out with the real tough one, because estimating the cash flows, you can do it from forecasting and so on. But we want to sort of figure out what the investor's required rate of return is. And the return, the investor's rate of return essentially is something that, let's say, is determined in the market. In general, as we said before, you can split returns into returns coming from cash flows or returns that are coming from capital gains. And we'll focus on returns expressed then on annualized percentages. Okay? Okay. Finance tells us that there is a risk-return trade-off. That if you're trying to get what the required return is, right, that an asset will need, one thing you need to do then is you need to be able to estimate what kind of risk is involved with this asset. So when you buy an asset, you try and estimate what the investment risk is. In finance, we typically measure risk by the volatility of standard deviation, and we also measure risk by the beta, which is the market risk. So we're going to look at those. Okay. One, how do you get the volatility of standard deviation and get a sense as to what the risk is? And once you've got the volatility and standard deviation, how do you make certain statistical statements about the risk? So if, for instance, you know what the probability distribution is of an asset's returns, then you can say, I'm not sure if I'm going to get 10%, but okay, I expect it, and I know with a 70% probability that I'll at least get that amount. So you can make that sort of statement. So we want to deal with this now here, just using a simple model. And then we'll go into looking at beta, how you get beta. In order to get beta, okay, we have to move into and do a little bit of portfolio theory. Right? So I'm not sure if you've all done portfolio theory. George has done it, Taylor has done it, Clay has done it, Olivia. Kira, no, he hasn't done 44. 44.9, did you 44.9? No, you've already done 44. Okay, well, we'll see. I know Ryan's doing it right now. So let's look at this distribution and say, if we can figure out what the probability distribution is, and this is a kind of a normal distribution. So this is stock A and stock B. Stock A's distribution is like this, and stock B's distribution is like that. Because stock B's distribution is spread out more, its variance is more, which means its risk is more. That is, both of them have an expected return of 15%. But with stock B, you have a bigger likelihood of getting minus 15 or plus 45. With stock A, your returns are going to be in this fairly narrow range. You don't know what they will be actually, but you know almost surely they'll be in this range with a maybe 95% certainty, okay, or probability, like likelihood will be in this range. So we want to be able to answer questions like that. How do we get this distribution? Well, typically you will look at a sample of historical returns, and from the historical returns, you will estimate its expected return, standard deviation, and then plot out the distribution. So the first thing we want to do is to do that. Take a look at historical returns and get a sense as to what the distributions are. This 15% is your first, what's called naive estimate of the expected return. Okay? But later on, you can refine that by using an asset pricing model. But we'll start with that idea here. So let's just go through the math. If you collect historical data, so you go onto Bloomberg or Yahoo Finance and you collect data on historical prices and historical dividends, you can calculate what the return is in any period using this basic formula, right, Nick? You buy a stock at time t for pt, and then of course at, I guess t minus 1. Let's just put time 0. And at time 1, you sell it for P1 and you get a dividend of D1. Your return then is P1 or D1 minus P0 or P2. So you buy a stock at some time and you sell it next time, your return then. And this would be your return in this period. Okay, so let's take a look then at some data there. If you go into Blackboard, you guys have that spreadsheet, Olivia, here. It's the valuation one. Okay. So these are returns from some stock. I'm not sure what it was. and we can see what the closing price is. And Yahoo and Bloomberg will also give the adjusted closing. The difference between these two guys is that this guy here adjusts for dividends. So when you use the adjusted closing price, you don't have to worry about this guy anymore. This has been lumped into this adjusted. So the adjusted kind of takes all of this together, kind of. Okay? So that's the adjust. So we'll use the adjusted closing. So what we want to do then is we want to get our returns using this formula, right? So we'll put that in. This is in October. So D2 minus this guy here. So this gives us our return in October. So it's the September, if you buy the stock in September at $35.24 and you sell it in October for 1 cent more, you end up with, oh sorry, you sell it, oh, I was looking at the wrong price. Okay, so you buy it for $34.78 and you sell it for $34.25, you end up with a negative return for that month. So once we have the formula in and everything is referenced properly, we can find out what this is. If you double click, it's a fairly lengthy data set. Typically, when you are calculating or using prices to get returns, you generally want a reasonably sized data set. So the standard is to use monthly data, 5 years worth, okay, of monthly data. That gives you a sample of 60. Is that right? In this case, however, our sample is a little bigger. Our sample goes down to C6. So we're using 30 years worth. 30 years worth of monthly data. So this will give us a rich enough sample, but it's okay. So we'll go down all the way to 359. We'll just remember where we're going to. Okay. So now that we have this here, we can calculate certain statistics around these returns. That is, what is of interest we know is the average return. That gives us this guy here. So our average return gives us this guy. That's our expected return. Our variance or standard deviation gives us a measure of the risk here. So how spread out it is this way. And so we need to calculate that. We also want to plot the histogram. And the histogram is this diagram here, but in sort of discrete form. So instead of the curve, it'll just be our histogram. And with the histogram, we'll also get something called the frequency distribution. Okay. So let's get our average. Kim, what function do we use to get the average? Average function, okay, that makes sense. Equal average. And so for the average, then do this. And we'll just go up 1. Okay. So our average is 1.9%. Our standard deviation we should actually just do that. For standard deviation, you're given a bunch of choices. You want to pick the STP, yes. So you want to pick this guy here, this one. And the reason you want to do that is you're dealing with a sample, okay? This other one here is for a population, and we'll just stop with that. So this is when you're dealing with a sample. The difference is not major, but it's slight. 1 divides by n and 1 divides by n minus 1. Okay, for our minimum, and we'll need this, we want to know over that range, what's the lowest return we had in any month in that 30 years. So in that 30-year period, what's the lowest we had? So we can say then this is the minus 18. Let me just do something here. Okay. Okay, the max then is the max function. We'll do the same. And the range, of course, is simply the max minus the min. We can see it's a fairly large range. And then the bin size, we'll leave that blank for now. Okay? The bin size is something that Excel's histogram function requires. It says essentially, if you are going to create this histogram, how big is this here? So this is your bin size. Is this from, every 5%? So you go from minus 10 to minus 5 to 0 and so on. So that's your bin size. Are you going from say 5% to 10%, in which case your bin size is 5, or are you going from say 5% to 7.5%, in which case your bin size is 2.5. Yeah? So it's saying how big are these bars going to be. So this is a choice then that you decide on yourself. And then you put the bins in there. Okay? So the first thing we do when we start to create our bins is we're going to now create these bins. We know what our bin size is. Let's make our bin size 4%. Now, so what we want to do is we want to go from minus 18 and increase things to 4%. So we want to go from minus 18 to 4% higher. Say that's about minus 14. Then the next range will be minus 14% to minus 10%. Then you have minus 10% to minus 6%, and so on. Okay? And so you create these bins this way. So the first bin, of course, then starts at H4. So if we do this, we start at H4. We're going to actually create a bin that starts at minus 20%, because we want this lowest amount. We want this minus 18, which is our smallest variable. We want it to be captured inside the first bin. Make sense, hopefully? So instead of starting at minus 18, we'll pick a nice round number and start from minus 20. say it's in minus 16. And so we know in this range, our lowest value of minus 18 will be in this bin. And we do that simply by rounding off the lowest guy, okay, to you round off the lowest guy there to one decimal place, okay? To one decimal place, to 10%, the nearest 10%. And so that gives us 20%. Then the next thing we do, let's speak about what's going on here, okay, is the following. Let's delete this so we can do it from scratch, okay? So let's do it from scratch. We have our bins, which is 20 to 16, and then it would be 16 to 12, and so on. So it's really them picking up these numbers, from 20 to this value. And so we want to say, well, normally we would say it's simply going to be equal to this J2 plus our bin size, okay, which is F2. And so that would be fine, and you'd get the minus 16. But if you keep doing that, okay, you might end up passing the max range. So you want to say, let's keep doing that, right, until the max range is reached. So we'll put the if function in there. If this guy here is still less than, and this is when we use that, that's here, less than or equal to our maximum. And we'll absolute reference that. If that's the case, then add that. Otherwise, just put a blank cell. So this will allow our table to, our bin table to be dynamic. Fair enough? Okay. So otherwise, put a blank space. And we said you could use blank quotation marks, but I like using this guy here. So once we have that, we can copy this down, I don't know, any decent range, just copy it down to here. Let's go even further. Copy it down to there. But it's saying essentially that it goes from minus 20, and once it gets to just above the maximum, which is 29, it stops. Of course, the formulas are still in here, but the table has stopped, right? So, yeah, and we can see what happens if we change it from 4 to 5, and our bins will change as well, or if we change this. And so you could put a spin button here. We'll speak about this in just a moment, because when you use Excel's histogram function, you create a chart, but the chart you create is not dynamic in the sense that it references what's going on here, but it does it by creating another table and then building the chart off the other table. So,
can you just click on the range cell for a second?
Really?
So much catch up.
Okay, and this is, we'll go back to 4. So now we want to create a histogram using these bins. So we have our data and our data analysis. And so we'll pick the histogram here. Yeah. Okay, with the histogram, it asks what's the input range. So where are the returns and the input ranges? Is that, let's go up one. What's our bin range? And our bin range is this. And so this is where sort of the problem comes in a bit, because even though our bin range here is dynamically changing, when you pick this, yeah, uh, you actually have to eyeball it to see where it stops, and then we want to ask ourselves later on. Suppose you want to plot something. And we'll do this, I guess, in this class or maybe on Monday. If you want to plot something and this is changing, how do you allow the chart, the series for the chart, the size to change as this changes? So all you have to do is change the bin size. This will change in size, and your chart will change. Okay? This is for to do that. Okay, it's not. I'll be honest with you. To do that is not easy. Okay, it's not easy. But it's really something that's nice to include in models you build, because you don't have to go back and putting your output in the form of a chart is always a very good idea, because most people are visual like that.
I don't have that data now.
You added it. Yeah. If you have a recent version of Excel, you go to added it.
Okay, I'm sorry, which data was that for the histogram and the range was? Oh, okay, I got it.
Okay. So the input range is where the returns are, but the bin range is where the bin is.
Sorry.
You don't need VBA for the analysis tool.
No, not this year, just it. There's analysis and then there's analysis. Right now, we don't need this. We'll deal with that very last week. Yeah.
If you don't have like a newer version of Excel, like it's not showing items online, should I just use the scout process application?
Yes, yes, yeah. This, so if you have many stuff or many facts, then maybe this is not here. But doing this now and so on, I'll ask, I think, is it only Clay that has posted to the discussion board? Nick, have you posted anything there? How come, Nick? You've just been busy? Oh, okay. So we'll give Nick something to post about this. Okay, Nick? We're building the histogram using Excel's histogram function. But you can actually build a histogram easily yourself. And if you want to create a dynamic histogram that will change as you change the bin size, there are three things you need to do. Okay, one is you need to have your chart be dynamic. So in this case, instead of using this histogram function, you use the bar chart function, but do it using count ifs. Okay. So what this is doing here internally is it's going to look at all these returns, and it will count from this 360 returns how many of them are between -20 and -16, and put that number in that first step. It'll also count how many are between -16 and -12, and put that number in the second sort of bin, and so on. And then after it's done that, it will plot that in a bar chart form. So it's not that hard to do yourself. But once you do it yourself, you are able then to allow this change in size. And so your histogram will change as well. Okay? As you just simply move that. Now we'll stick to this. We could create a new worksheet, but let's put it close by so we can just keep an eye as to what's going on. How about putting it up here? Oh, what did I do? Not good. Our output range. put the output range close by. So we said, let's put the output range here. And we'll do a chart output. If you don't do a chart output, it will just calculate the frequencies, how many are in each bin sizes and so on. And so we'll just click OK. So we can go over here and see what's happening. Okay. Okay. So what the histogram has done essentially is it's calculated how many returns are, in this case, less than minus 20%. How many returns? And there are none. How many returns are between minus 16 and minus 20? There are 4. How many between minus 12 and minus 16? 7. Between minus 16 and so on. And it's sort of done all that, and then it's plotted it then in the histogram form. So this is essentially what the histogram looks like. You could change this number here. This frequency is are these numbers. You could change it to create what's called the cumulative frequencies, but that will give you a different sort of chart. Okay. Yeah.
So I don't understand why the minus 18.81 would be used.
No, it turns out that the way it counts this is it actually counts what's less than that number.
Oh,
So less than minus 20.
Okay, so, all right.
Between minus 16 and minus 20. So minus 18 ends up being the second. Okay, with this, we can ask ourselves the following. Okay. We know now what the expected return is. It's 1%, 1.09. We know the standard deviation is 0.65, but we can answer certain questions statistically. So we can answer, for instance, what is the likelihood of having a return of greater than 12%? So what is the likelihood of having a return greater than 12%? Bunty, what do you think? What's the probability from this here that your return in any given month will be greater than 12%? What's the probability? Nick, what do you think?
Pretty small.
It says
Like
it's
exactly
reasonable. So we could put that here, and this is our cumulative frequency. And essentially that's that. And this is what's that? And let's put it in percent terms. Okay. This is just oops, sorry. Instead of dividing by 100, we should have divided by, well, just to be on the safe side. We'll just put that there. So instead of dividing by 100, you should divide it by the total sample size, right? So even that's not. Hmm.
GSO.
It seems good. I'm wondering what's happening down here.
Is it the absolute reference?
The absolute reference seems to be fine. M2, M15. Okay. M4. Okay, so we should absolute reference this guy here, right? M3.
Yeah, so it keeps adding each second. Isn't that right?
Okay, let's do this then. Sum M3, M2. And we'll absolutely reference that to what happened here. Okay, we'll get this. So we want to add from here, absolute reference that to here. Okay. So, what do you think, Kara? You think that'll work now?
I just figured out how to get my Instagrams.
What we want to do is we want to find what's called the cumulative frequencies. So we want to say essentially, up until here, how many of these are, we want to sum up until here, sum up until here, sum up until here, and so on, and find what the percentages are. So that gives us our cumulative frequencies. So that must okay. Okay. What do you think? That works?
Is that your original frequency, by the way?
The original frequency, there's no formula here. This was generated by the histogram function. Now, Nick is going to show us how to get this here using the count if. So Nick, think about it. You don't even have to wait until after class. Just think about it. So let me give you the count if. Have we used this before? The count if function. Count if takes an array. Count if. It takes an array and it says, look at the array and count if you have some condition. Okay, that's relevant. Generally, for your condition, you want to put the condition into quotation marks. So for instance, count if your array is E2 to E, say 358. And you can say count if this is less than 20%. We put that in quotation marks. And it counts how many of them are less than 20%. Right, Nick? Now, in our case, we want to count if it's less than 16 but bigger than this, so you'll need two conditions. Okay. Normally, you'd like to be able to put an and into here, an and function, and say count if it's this and something. But the and function doesn't work too well inside the count if. So what Excel does is it allows you to have multiple conditions, count ifs. And then you have array condition, and you have it. So Nick is going to give it a try. I suggest you guys sort of give it a try to 2 minutes. Okay, yeah. Well, let's just do 2 minutes and see if you can come up with a way then to reproduce this, okay? That's right. So we want to reproduce that here, frequency. Want to reproduce it here. Okay, Nick? And go ahead, Quentin, give it a try. Use the count ifs here and see if you can reproduce these numbers over here. We can see that the bins are still the same, and that's fine, but we want to reproduce that. And reference these guys. Don't put -20, reference what's going on, reference this. Oh, it looks like here, no. Yes. So look at this, this will allow you to bypass histogram function here.
Yeah, I have it, I just.
Yes.
Which one's
Yeah.
two?
It's kind of the same, but maybe some like. It looks like it's the same, yeah. It looks like it's the same. The only difference, and you'll see this. We'll ask someone else to do that. Let's ask Val. Val, with this histogram that we have here, it's a bar chart, but you can see it's kind of split. These spaces in between, they're rather irritating, aren't they? So, what we'd like to find out for us is, how can we get rid of the spaces in between? There's a way you can do it. So you go into the chart and you compress the bars together. Val will find out about that and let us know on the discussion board. Okay, so Nick, is it working?
Not yet. I'm sure.
Simari is working for you? Well, let's try one count if and see. Okay. Count if. So we'll try to count if here. And our range we said was this E2 to E58. That's our range. And our criteria. For now, we're going to use one criteria, and we're saying it's less than this guy here. Let's see if that works. Less than J2. Frequency, we don't want it in percent terms. Format says. Sure. Right. Just to remember. And if we do this here,
I have the same result, let's keep getting zeros.
I guess it's the referencing from here. We have to be able to take what's in there and put it in as a text. That means we probably have to use the indirect inside the count if. Okay. Okay. We'll come back to that. We'll let Nick keep working on that outside class, and we'll come back to it. Let's move on a bit here. With this, okay, our histogram, we're going to need a few things moving forward. Okay. So now we have a sense as to the risk of an individual stock. Given an individual stock, you can go and get its historical prices. And from its historical prices, you can get the historical returns, get the mean, the variance, the standard deviation, and plot what its probability distribution looks like. We can answer certain questions around that here using this cumulative frequency distribution. That is, what's the likelihood that these returns are less than 32%? Okay? And the answer is it's a 100% likelihood. The maximum return we saw in the last 30 years was only this amount here, 29.4%. So there's a 100% likelihood it's less than 32%. Over here, there's a 95.53% likelihood that it is less than 12%, which means there's a 4.47%. Okay, so there's a 4.47% that the return you see will be greater than 12%. So if we look here to answer that question, if we look here to answer the question there, what we're seeing is that there's a 95.53% likelihood that it's less than 12%, which means there's a 4.47% likelihood that it is greater, okay, than 12%. And you can take any one of these bin sizes and say, what's the likelihood of seeing a return that's greater than 8%? Well, greater than 8%, you're looking at something like an 11.73 or something. Okay. It's weighted. So, Clay, to answer what the question you were thinking, given historical prices like this, Clay, okay, historical prices like this, here, could you calculate returns, get the average standard deviation, min, max, bin size, draw out the histogram, and answer a question like what's the likelihood that it will be less than 8%, and do all of this within the space of an exam? Yeah, it's possible? Okay. Okay. When it comes to valuation and returns, we often move into portfolio theory. And we do this, of course, because the expected return for a stock is not really based on its standard deviation. It's generally based more on its market risk. And its market risk comes from the risk that it adds to a well-diversified portfolio. And that is picked up essentially by beta. So we want to ask ourselves, how can we build in a model that will capture what's going on inside a portfolio and find out essentially what this stock's risk is to the portfolio? So since we know how to calculate or get individual returns and standard deviations, once we have that, can we put that information into a portfolio and then answer questions around the portfolio, like what's the best kind of portfolio to form with these 3 or 4 stocks? Okay. With a portfolio, after you get the expected return for some stock 1, the expected return for stock 2, you get the standard deviations for the stocks and so on. With a portfolio, there's one more thing you need to be able to get going, and that is the correlation or covariance between any 2 stocks. And that's sort of picked up by this little guy here, correlation. For those of you who have taken 4407, even just the last class, you would have seen this here. The covariance between 2 stocks, stock 1 and stock 2. And the correlation between stock 1 and stock 2 is the covariance between stock 1 and stock 2. We usually work with these guys here. That is the covariance between stock 1 and stock 2. So we usually work with this. Call it this correlation here. And so we're saying to find the expected return on a portfolio, right? So you saw this on Monday. You simply need to know what the weights are for each stock, and you find the weighted average of the expected returns, and then to find what the standard deviation is for the portfolio. You know what the weights are, and then you put it into this ugly formula. Now, we're not going to use this formula or this formula. We're dealing with Excel. Okay, so Excel has a lot of power behind it, so we don't have to worry about those formulas per se. We'll show how to do it in Excel. However, to do that, this is stuff about the correlation. The correlation between two stocks. What information does it give you? Levi, you remember this. What do you think? What does it tell you between this stock 1 and stock 2? Correlation between them. What information does it give you? It gives you essentially the information as to how they move together. If one stock goes up by 5% and the correlation, say, is 0.4, then the other stock is likely to go up by 0.4 or 5%, okay? Or by 2%, and so on. So the correlation tells you how the stocks move together. Correlation goes from -1 to +1. If it's +1, they are perfectly positively correlated. They move lockstep together. If it's -1, they are mirror images, perfect mirror images of each other. One stock goes up by 1%, the other goes down by 1%, and so on, mirror images. In between, then it's not perfect, but they are somewhat related. Okay? So the correlation picks up that. The correlation number we have, of course, comes from the data. Excel has two functions, a covariance function and a correlation function. So this is correlation function, and covariance function. I will be able to calculate that. In order to use these functions, shall we say properly, let's go to we'll come to the M mult, but let's speak about this guy here, these two, dynamic names and using the indirect function. Okay. So we'll start with dynamic naming. Okay, dynamic naming. So let's go back to our cell here and ask ourselves, can we name this, okay, as bins? So we want to be able to essentially create a frequency distribution that will match what's going on with the bins per se. So let's create a dynamic name for bins. So we'll first go to here, okay, and we'll name that as bins. Too late, it's done. I think. Bins. Okay. Then let me just check something here. Oh, the screencastify. Is there a... Okay. Then we'll go to our naming manager here, our name manager, and where we see bins, we'll see what these are. So what we want to do, okay, is to use something called the offset. offset kind of allows you to start anywhere in Excel. And from here, it allows you to reference any particular point in Excel and a range from that point. Okay? So you're saying if you're over here and you want to reference a range here, it allows you to reference this range relative to where you are in Excel. So it's saying from where you are, what is that range? So that's the offset function. Okay. So let's first deal with the offset function here and see what it looks like. Offset. Offset says, what's the reference? Okay. And so you can pick a particular reference. Here, for instance, let's pick A1. So let's pick this A1. And we want to move from A1 over to a certain number of columns to the right and rows below. Suppose we want to pick up this number here. So this is how many columns to the right and how many rows below is this? So this is two columns to the right and 7? Okay, so we'll go 7 rows below, 2 columns to the right. And then we're essentially starting from here. And from here, we can now select a whole range. If we wanted to select this whole range here, we wanted a height of, say, 10 and the width of this amount, we can now select this whole range, picking a height. But we just simply want we just simply want a height of 1 and the width of 1. And oh, the columns was 2. Okay. And so it takes in what this is here. So that's the offset function. The offset function has a fair amount of versatility, but one thing it's often used for then is it's used to create then the dynamic range. Okay? Okay. So let's go back now into our name manager here and our bins. So we're going to use the offset function here. Okay. So we'll say offset, and it's going to be, we'll start at J2. So that's where we're starting for bins. We want it to stay at J2, so we don't want it to move up or down. So we'll put 0 rows to the right, 0 rows below, 0 columns to the right. So it's starting at J2, 0, 0. Okay. And then we need a height, right? And this is where the offset then comes in. So now we use we use another one of these guys. We're going to count how many for our height. We're going to count how many blanks there are.
Do you want to keep that preamble? The J?
No, I'm going to remove it.
Oh,
Yeah, I will remove it eventually. Yeah. So for the height, okay, we're going to put the count 8. Okay. The count 8. So let's pause here again. Let's pause here again and go back and see what the count A does. Okay? So we've seen what the offset does, the offset function here. We've seen what this guy does. Let's see what the count A does. And it tells us that it counts the number of cells that don't have blanks, that aren't empty. Okay. So that's what count A does. And so you pick a range and it counts how many cells are not blank. So note that in this bins that's here, we have our formula that goes all the way down. Our formula, you can see it's it's kind of way down to here, to 102, right? We can see that the formula actually goes all the way down to here, but the cells are blank for a considerable amount of time. So we can stick to this 102 and we can ask ourselves here, count A. J2, J102. So it's saying how many of these are not blank. And now we know it's just these guys here. 2, 4, 6, 8, 10, 12, 13. So 14 of them are not blank. So if,
Did you see J2 to J4 too? Or J1 or 2?
106. That's not good.
Is it because it populates with text?
Huh?
Is it because it populates out with text?
No, even if it did, that's supposed to be a. It's populated with text, but I mean, what we have here is a case where it's supposed to embed a blank function. You want 14? You did? How come
Is it because you have a space in there? Like, just two double quoted, yeah.
No, I didn't.
But like, I still have the line, just
Okay.
the repeated line in it, I'm getting the 100.
So you guys, you got 14? And
Yeah, I got 18.
you have 18?
Yeah, I'm not sure.
Olivia, what's going on?
I have 26.
How can you have 26?